We are always told that the economy is like a fine piece of clockwork. Everything has to fit perfectly in order. And even one small change can have second or third order consequences that could be devastating. Like that time, a small tweak of banking regulations directly led to the biggest economic downturn we have seen since the Great Depression. Or that random day a small adjustment in a foreign currency wiped trillions of dollars off the market. These were obviously important disruptions to a delicate system. But at the same time, in just the last 12 months, we have announced sweeping tariffs, and then canceled them again. Then announced and then canceled them again. Announced and then implemented, before canceling them again. Implemented them again, then raised them, then lowered them, then organized special deals for certain companies and countries, and then canceled those deals, and then took the issue to court, resulting in us potentially having to pay back all of those tariffs. And now we are implementing them again, on countries that don't want to give us Greenland. And oh yeah, we have threatened our most significant allies and largest trading partners. Threaten the chairman of the Fed. Threaten individual companies. Threaten the basic fundamentals of consumer finance. While also re-implementing debt repayments that people had been pretending to ignore, all at the same time that we shook up healthcare, fired tens of thousands of government workers, and then hired most of them back, and then fired some of them again, and then closed the department that was doing the firing in the first place, while we still accumulated new debt at a record rate. Because one of the most sweeping tax changes in recent decades, we saw the single longest government shutdown in American history significantly change both documented and undocumented immigration in the labor market. And this isn't even to mention the nerdiest stuff happening behind the scenes in banking, like the Basel III in-game standstill, which means that banks really don't know how much money they are supposed to have. None of this is even meant to be some kind of partisan attack either. Some of these things, like student loans, eventually needed to be dealt with. But no matter what side of the fence you personally sit on, it should be pretty clear that things are very turbulent right now. If the economy is supposed to run like a fine Swiss watch, then we have been adjusting it with a jackhammer. But yet, it is still going. Over the same time, the economy still grew, unemployment remained relatively low, incomes went up, and the market, which is supposed to hate instability, is hovering around all-time highs. Now yes, of course, there is a lot of nuance to these metrics and measures that gloss over some real problems. But that is actually exactly the point. There have been plenty of far less compromised economies that have folded under less pressure. With the sheer volume and severity of shakeups that have been hitting us, it does raise the logical question, why hasn't the economy collapsed yet? 25% tariffs on Canada and Mexico, and a 10% tariff on China. President Trump now pausing tariffs on both Canada and Mexico. Now there is a threat possibly of 100% tariffs on China. Gold made a decisive comeback. Central banks increased gold's share of reserves by 12 percentage points, pushing it to 28%. Shoppers in the United States are stocking up on imported goods, hoping to save money. 96% of the tariff burden, borne by Americans. He has been wrong. That is why I call him too late. He is too late. Okay, so the first thing you are probably thinking is the same thing. We have covered extensively on this channel over the last year. AI spending is just making the big numbers look good. Yes, there are real structural issues in the economy, but the mountains of cash that tech companies are spending on AI infrastructure development has done a landlord special and painted over all of those cracks. Things are still rotting away out of sight, but on the surface, everything looks good enough. According to the Bureau of Labor Statistics, our GDP was growing at a rate of 43% when annualized in Q3 of 2025. We don't have the figures yet for Q4, but without some kind of major surprise dragging the entire year down, these numbers look really good. But, well yeah, the trillions of dollars going towards data center construction and computer chips are now contributing more to this growth than consumer spending. Not a great sign. It in the biggest consumer market in the world, but you probably already knew this. What might be surprising though, is that, according to the BLS themselves, overall investment in the economy actually decreased ever so slightly in the third quarter, bringing down the net growth figure overall. So how is it possible that investment is single-handedly keeping the economy alive, while also being practically insignificant in the overall economy? Well, because this is a net figure. AI spending alone would contribute about 25%. But that spending is being completely offset by companies slowly selling down their own inventory. When a business or person buys inventory, or some kind of other produced asset, it gets counted as a positive investment. But when they sell it, it is subtracted from that same category. This is how statisticians avoid counting the same thing twice. If, for example, a machine shop made a part in one quarter, kept it in storage for a little while, and then sold that part to a customer in the next quarter, only one part has actually been produced. So, only the final price should be counted. What businesses have overwhelmingly been doing over the last year is selling off stuff they filled their warehouses with before all of the tariff shenanigans really got started. A decline in inventory has almost perfectly offset an increase in spending done by AI. So if that spending suddenly stopped, then things would suddenly look a lot worse than they do right now. However, that is still not the whole story. We will get to consumer spending soon enough. But before that, government spending and our own balance of trade also, almost inexplicably, look really good too. Government spending is up because the net impact of DOJ cuts was effectively negligible. And we are also spending more on the military, so that is simple enough. But trade deserves some special attention because the numbers alone are a bit unintuitive. A reduction in imports is actually good for GDP. And, according to the data, we are simultaneously exporting more and importing less at the same time, which raises the uncomfortable. Are the tariffs actually working? Well, spoil alert, no. But it is time to learn how many worse. To find out why these positive figures might actually be far more dangerous than we realize. This week's video is sponsored by Monarch Money. Monarch Money is a private, ad-free personal finance platform that brings all your accounts into one clean dashboard. It automatically tracks your spending and net worth and helps you stay financially aligned without juggling spreadsheets. Instead of just showing where your money went, Monarch makes it easy to see the full financial picture, make smart adjustments, and make progress towards your goals with confidence. Plus, with bank-level encryption and read-only access, it is secure. And thousands of users have given it a 49-star rating. I started using Monarch for my monthly budget check-ins, and it has been a game changer. All my accounts, cards, loans, and investments sync from over 13,000 institutions into one beautiful view on web or mobile, saving me time hopping between apps. I love the flexible budgeting that separates fixed and flexible spending, with customizable rules and categories. And the insights explain spending changes or unusual transactions in plain English, helping me stay aware without constant alerts. Seeing my net worth trend in goal timelines for saving or paying down debt makes progress feel real and motivating, without the stress. Try Monarch yourself. Go to the link in the description and use code HW50 for 50% off your first year. Okay, so yes, we are importing less stuff into America right now because tariffs have disrupted business spending. And because those same businesses loaded up on stock at the beginning of the year and are just burning through their supplies. It is not exactly the success story of everybody suddenly deciding to buy American after a tariff got slapped on the imported alternatives, because, well, often there is no American alternative. So that is not great, but at least we are exporting more stuff, right? Well, exports have indeed increased, which sounds shocking, considering that we have really been testing our trade relationships. But it becomes a little less shocking when you realize what we have been exporting. The fastest growing category by far is precious metals. From October 2024 to October 2025, total exports grew by $26 billion after accounting for inflation. Of that number, $14 billion was just from increased gold exports, a 517% increase from the year before. Now partially, this was because each ounce of gold we sold was worth a lot more. But that price appreciation was largely thanks to everybody trying to diversify away from the US dollar to a reserve asset, so I don't exactly know if we could call that a win. Even adjusting for the price, we have still just exported more gold in total to wealth safe havens like Switzerland and London. On top of this, an additional $4 billion in export growth was from increased silver exports, representing year-on-year growth of 20,800%, meaning that out of a $26 billion increase in exports, $18 billion is just because we are selling more silver and gold, and the remaining $8 billion has largely come from military and energy exports. So yeah, our balance of trade looks good, because everybody is too scared to stock up on inventory, and we are selling off our precious metals. By the numbers alone, our economy looks healthy. But this is kind of like saying that you have improved your household's financial position, because you have been living off your supply of canned beans, and you sold your car and your kidney. For now, the cash flow looks great, but you can't really keep doing that forever. Now maybe it is a bit hyperbolic to call this a going out of business sale. But other countries trying to pull fungible stores of wealth out of America as quickly as possible is generally not a great sign, but it gets worse. Strong growth in consumer spending is generally a good sign that things aren't going too badly. Because normally, people don't spend more money unless they are making more money, or are confident that they can stretch their budgets a little bit more. From the data, we can see that even with all of the funny business going on in these four other categories, consumer spending still makes up a majority of the net contributions towards GDP growth. But there are some other caveats. The first is, well, yep, you guessed it. You are probably sick of hearing me say it by now. But a record amount of that spending is being done by just the wealthiest households, meaning that this growth isn't necessarily a sign that all consumers are feeling confident, and is more of a sign that wealthy people have enjoyed highly appreciated assets. But for the sake of this question alone, that actually doesn't matter. If the economy was seriously hurt by any of this turbulence, or even if these households thought the economy would be hurt, we would still normally expect them to reduce their spending. As their businesses failed, their bonuses shrunk, or their investments faltered. But they aren't. If anything, they are actually spending too recklessly, resulting in a record number of very high-income households getting themselves into financial difficulty. It might be really dumb for the individuals, but it does mean that businesses have been very comfortable, producing lots of goods and services, even if they are increasingly catering just to the wealthy. So maybe the rumors of our impending demise were greatly exaggerated after all, right? Well, you probably should have seen it coming at this point. But let's take a look at a good number and explain why it is actually a bad number. Most of the growth in this consumer spending came from healthcare and other non-durable goods, which the BLS notes was primarily made up of pharmaceuticals. It is no secret that insurance and prescription prices have gone up for most households. But these measures are supposed to account for those price increases. And just look at the actual services being provided. So there are actually three things that have been driving this extra output from the healthcare industry. The first is simply that we just need more healthcare. An industry report by McKinsey generally summed it up: that Americans were on average getting older, fatter, sicker, and less engaged with their health. The second factor was the growth in offerings like GLP-1 drugs that have driven a lot of demand for pharmaceuticals. And the third variable is simply that a lot of people are afraid that they are going to be pushed off of their health insurance plans in the coming months. So they are in a bit of use it before they lose it situation. On top of all of this is a massive system of bureaucracy and broken incentives that I will actually be making a video on next month, so make sure to subscribe for that. But in the short term, all of this activity has contributed to consumer spending because healthcare and pharmaceuticals are really expensive and really hard to say no to if you actually do need it. So hopefully all of this adds some relevant and slightly depressing nuance to an apparently red-hot economy. This economic growth is really good. There is no denying it. But a lot of the factors contributing to that growth are either not sustainable or not discretionary. And that is before we consider the biggest caveat of all. Our economy may have grown by around 4%. Again, depending on what Q4 results look like. But the US dollar has fallen by over 10% compared to most other major currencies. Now, it is not as simple as saying that this means we are really 6% worse off. But this kind of rapid currency depreciation quietly helps some of these figures look better than they should be right now, while simultaneously indicating some problems in the future. For example, the stock market has grown to record highs, which helps explain why wealthy households are still willing to do a lot of spending. But when denoted in most other currencies, the market has either traded flat or actually gone backwards slightly. This currency depreciation has also made our exports cheaper and imports more expensive, helping to explain the boost from both of these categories. A person that has seen their stock portfolio increase by 10% in a year might be happy to spend a little bit of extra cash. But when an overseas vacation or imported car is 10% more expensive, then some local alternatives suddenly look a lot better. Now, if we were actually a net exporting economy, this might actually help us out a little bit by making our exports more competitive in global markets. But unfortunately, we are the largest net importer on the planet. So what it will actually do is just make most things more expensive. This is also on top of the tariffs, which, according to a study conducted by the Kiel Policy Institute, have overwhelmingly been paid for by regular consumers. The report tracked the end price of 25 million transactions and found that foreign exporters were absorbing around 4% of the costs, with the remaining 96% being passed through to households. So yeah, eventually we are importing less while paying more for it. It is not great. But it still is not the collapse that a lot of pundits might have predicted. The reality is that it is just too early to tell. The American economy is not invincible, but it is both very large and very privileged. The size of our consumer and financial markets mean that things are not going to play out as quickly as they would in most other countries, that are a lot easier for foreign institutions to move away from when things look risky. We also have some of the most widespread and entrenched agreements, alliances, partnerships, commitments, engagements, and even just good old understandings with almost every major other economy worth mentioning. These have all been tested clearly, but no matter how hard we try, they won't fall apart overnight. Now, in the short term, that is good because it means we have time to see things going wrong. But it also means that things will take a lot longer to get back. If other countries, investors, and customers start trying to work around us rather than with us. Now, it certainly doesn't help that a lot of these decisions are being made by people who won't be around to see the consequences of them. But go and watch this video next to find out how the boomers are slowly losing their long-held grip on power. And don't forget to like and subscribe to keep on learning how money works.